Well, once again, hello, everybody, and welcome to the July Lear Market and Strategy webinar. My name is Tom Steinley. I am Director of Business Development here at Lear, and I'm joined by my colleague and co-portfolio manager, Head of Research at Lear, Jim Warner. On behalf of Jim and myself and the rest of the Lear team, we would like to wish you a very happy and relaxing 4th of July holiday week. It's hard for me to believe that exactly half the year in 2024 is in the rearview mirror, but there's a lot happening, and I'm going to turn it over to Jim in a minute. But before we do, I just wanted to remind you of a couple of things. One is please ask questions. That's what these webinars are for, to answer your questions. The way to do that is at the Q&A button at the bottom of your screen. And then also a reminder that as a follow-up to this webinar, we will be sending you a compliance-approved replay as well as Jim's slide deck. So you can reference the webinar again if you need to, or if you need to or like to send to end clients, it's approved for that use as well. So with that, Jim, I'll turn it over to you. Let's jump in.
All right, great. Thank you, Tom. And thank you to everyone who took time pre-holiday out of your schedule to join us today. So yeah, as Tom mentioned, we are now halfway through the year, and then what a half year it has been. If we really step back and think about what's happened, is that it's been really a year thus far powered by AI. As you can tell from the headline indices, the returns have really been driven, and I'm going to give you some more specific data here in a second, but S&P is now up about 15%, NASDAQ's up about 18, 19%. And if you look at the S&P 500 equal weight and the Dow, you can see that they've been big laggards. So they're only up about 5% year to date. Now, obviously what's going on here is that you have a collection of names like NVIDIA, which is the most obvious, Broadcom, and other AI chip names that have really taken off this year. In fact, if we look at actually how much performance is being driven by these AI chips, it's pretty phenomenal. What you can see in this graph here is that basically more than half of the performance of the NASDAQ and almost half of the performance of the S&P 500 has been driven by these chip names. So pretty phenomenal. If you hopefully got my newsletter that I sent out earlier this week, if you didn't, just reach out to us. We'll get it to you. But one of the things I pointed out in that is that it's really hard to run portfolios that aren't underweight these AI chip names. When you get this kind of narrow performance driven by just a handful of names, it's really hard for portfolios usually to keep up with that without breaching all sorts of risk parameters. But nevertheless, if you stripped out these AI chips, the rest of the market's actually doing pretty well. The rest of the market effectively accounts for about 8.5% of the 19% in the NASDAQ's return this year, and about 9% of the 15% in the S&P 500. So not too shabby. So it's been a good year for equity investors thus far. It has not been a good year, as we've talked about a lot, for bond investors. However, we think things may be turning a corner. The U.S. Aggregate Bond Index, which is obviously the broad measure of treasuries, mortgage-backed securities, investment-grade bonds, etc., is essentially flat, down 0.7% year to date. And with today's really weak PMI services number, actually, I think we'll flip to positive. But we've been positive now for the last couple months, and we're beginning to wonder if that's a good positive sign for bonds for the rest of the year. So let's dig into some of the key macro issues. Let's head off the path with commentary around inflation. It does appear that it's headed in the right direction. The market is now pricing in about 2 cuts for this year. And I think we can be reasonably certain, given the direction of inflation, that rates are likely to head lower before they head higher. I don't expect rates to really move much higher. And so this does beg the question of whether this puts a floor under bonds. Just for detail, because I always talk about housing and how relevant that is for core PCE, the Fed's favorite gauge of inflation. You can see that PCE came in at 2.6% last month. Or actually, that's a May number. We'll get June's number at the end of this month. But embedded in that is about 5.3% year-over-year growth for housing. And so if we strip that out, core PCE X housing is 1.9%. So right in line, basically, with the Fed's 2% mandate. So I think what we can do is we can start to de-emphasize inflation because it is heading in the right direction. And the thing that is basically, as I've been trying to communicate to folks over the last few months, what's getting me more and more worried is that the Fed doesn't cut soon enough. Are we living in a world that is too restrictive? And what I did here was, and obviously the narrative from the Fed, and we heard a bunch of Fed speakers come out last week, has been the higher for longer narrative, that they want to see more data points before they're willing to cut. And the markets try to figure out whether that means a cut in September, or maybe they wait till after the election in the November meeting. But my concern is that you hold rates too long and you really start to damage the economy. And so if I went back and I've shown this graph before, but we're getting really close to what I'd call the danger zone, where the Fed funds effective rate, which is around 5.3% according to the overnight repo market, and you subtract out core PCE, which, as I showed on the previous slide, is 2.6%. You get this line graph, and what this essentially shows you is that before the dot-com crash and before the great financial crisis, we had a spread between those two that was basically as high as where we are today. And so it makes you wonder if the Fed has basically hung on to these high interest rates a little too long. And so this is the thing that kind of keeps me up at night. And this is this fear that we basically have not seen the full effect on the economy of these higher interest rates. Just to actually put a side note on that, the used car prices, according to the Manheim Index, is now down 25% from its peak. So, I mean, that's a space where you can clearly see the effect on payments when you buy a car, when you get an auto loan. So there's, that kind of ran through, and we haven't seen the end to lower used car prices either. But we haven't also seen it really flow through the rest of the economy as dramatically as used cars. So that's what we're keeping a very close eye on. But the two data points that will really start to show this is essentially the labor market and consumer spending, as we've talked about how important that is for the overall economy. And so with inflation trending towards the Fed's 2% goal, really our focus is on these two data points. So if you want to, play along, be focused on, the payroll number that's going to come out this Friday. That's an extremely important variable. It was weak last month. If it's weak again, we're going to see interest rates lower. How weak is really we're walking on a bit of a fine edge here, because the Fed wants a weaker labor market, but it doesn't want it too weak, and then we fall into recession. So we're walking kind of this fine line between weak enough that the Fed can cut, but not too weak that we have a recession. So that's why we're watching these data points really closely. Now, the other thing that obviously that will drive is the labor market, and is consumer spending. And so the graph on the right shows you what personal consumption expenditures have done since 2019. And effectively, if we look at April 2021 and we measure from that point, why are we choosing that? Because March 2021 was when all the fiscal stimulus checks were sent out, and that's when we really started to see inflation kick in. From that point, personal consumption has grown 22%. It's pretty dramatic. I mean, we haven't seen this in history, this level of this growth in spending. But 18 of the 22% growth was from higher prices, was from inflation. So when you step back and you ask yourself, are people consuming more? Not really. They just have to pay more for what they're consuming. So this isn't as strong in a consumer-led economy as maybe the headline spending number would suggest. So something to keep in mind as we start to think of the consumer now having to deal with higher interest rates on top of higher prices. All right, so what does this do in terms of impacting our portfolio strategy? And I basically made this list of about 5 things that are kind of top of mind, key considerations as we think about managing all the portfolios going forward. The first point is about AI. AI is real, but looking for names, but it's important, we think, to look for names that aren't just the chip names that have really worked. It's looking for the names that will benefit as AI is adopted across the economy. So that's why we've added biotech to our main strategy, global vigilance. Why biotech? Because it seems to us that AI could play an enormous role in expediting drug discovery processes. We also added Oracle, which basically manages a cloud platform that all this AI stuff sits on. And as we grow all these AI data centers around the world, Oracle is going to benefit from that trend as well. And of course, we've had cybersecurity in our portfolio for quite some time, and CyberArk. Other names are going to benefit that are in the portfolio, but the key is that we're looking not to just, we still own NVIDIA, and it's done great, obviously, but what's the next NVIDIA? That's our mindset always. If NVIDIA is up a lot already this year, let's buy something that isn't up as much, that has the same kind of potential earnings power that we've experienced in the AI chip sector. The second thing, and we're going to talk a little bit more about that here in a second. I'm going to scroll through these in a little bit more detail. The second thing is we're starting to pivot towards long-term fixed income. So what does that do for the portfolio? It adds convexity or sensitivity to interest rates. We think that this is a great idea for a couple different reasons that I'll go into in a second. The other major consideration going forward is the election. And here you'll see that I said Trump versus Biden with a question mark. Well, if you've been paying attention to the news today, I think we could have put maybe 2 or 3 more question marks after Biden's name, because there does seem to be some rustling amongst the Democrats, the high-ranking Democrats and their donors about potentially replacing him. The other thing, and I mentioned this previously, but has the Fed held interest rates too high for too long? So we're really digging into what companies are saying about how they're changing the way they do business. Are they laying off workers? Are they trying to increase prices? How are they managing through this higher interest rate environment? Because a lot of business models were built during zero interest rate periods. So, how do these things evolve? How do credit card companies, adopt to this higher funding cost? There's lots of different. How are banks going to adapt to it? So we're watching very closely. We have another earnings period coming up. Starts basically next week, and we're going to learn a lot from listening to companies about how they're managing through higher interest rates. And then lastly is the consumer cracking. So back to consumer spending. Have we seen the highs put in on consumer spending? And I went through last month's webinar was dedicated to this topic. So I'd encourage you to go back and rewatch that for some of the signs, because there are some signs that particularly the lower end consumer is getting really stressed. But overall, things are kind of hanging in there. So back to the AI trade here, for example, and there is an evolution, right? Right now, we are effectively in the very first inning of AI and its impact on business and in society. So this is a very long, there's a very long tailwind to this secular trend, we think. It's not just chips. Obviously, NVIDIA is up 150% year to date, but there are others that have not benefited nearly as much, including cloud platforms, memory chips, cybersecurity, and in particular, end users. So what is, I think we all need to be thinking about what is the impact of AI on our own businesses. I know that we've been developing a way to analyze portfolios using AI, but even outside the financial services world, how is AI going to change businesses to make them either more efficient or maybe increases the number of revenue line items that they have? So there's AI is clearly a game changer. No one knows how this is actually going to play out. but it's something that is a powerful theme that we've been involved in and we will remain involved in. Bonds. I've been talking about bonds for a long time now, and they haven't worked. But this may be about to change as the Fed turns to rate cuts. So we may have put in our the interest rate highs. I mean, there's always volatility and whatnot. It's all always data dependent. But the bottom line is that I think we've gotten to a point where we're at least going to get some stability, and that's great news overall for bond prices, of course, because bond prices go up when yields go down. But it's great for conservative investors whose portfolios have just lagged dramatically, and it's also a great place for more moderate investors, because bonds are now going to actually act the way they've typically acted in history, is as a hedge to your equity portfolio. So, what that means essentially is that traditionally, when stocks go down, bonds go up. And I think we are actually moving back into a period like that. So what this all means is that we need to start adding convexity and interest rate sensitivity to the portfolio. If interest rates do nothing, we're going to sit here with, a 5% yield or better. That's essentially where this is the aggregate bond index right now, is sitting at a 5% yield. 5% yield is pretty good. If something goes wrong with the economy, we're going to see the yield drop and the bond prices go up. And so we think that this is going to be very important over the coming probably 6 to 18 months, where we figure out exactly the direction of the economy to have this kind of hedge in portfolios. All right, so I mentioned Trump versus Biden with a question mark. We took a look at Odds Checker, which where people literally bet on who's going to be the next president. And before the debate, Donald Trump was the favorite at -112. After the debate, was the favorite at more of a favorite at -137. Joe Biden basically saw, based on his pretty lackluster performance, saw the odds grow worse. And then the potential replacements saw their odds of becoming the next president really improve pretty dramatically. I actually went back and checked this website today, or just moments ago, and Joe Biden is now at plus 720. And Kamala Harris is now at plus 740. So essentially, the odds makers believe it's a coin flip as to whether Biden or Harris is going to face Trump in the general election. So obviously, this is a big moving target. Yes, there are implications on the market, probably more broadly, but I think what you're going to see is, as we get better sense for how the presidential election, and importantly, how those congressional elections come out, we can then start to make more definitive conclusions as to which sectors are going to do better. So not surprisingly, after the debate, and Trump won the debate, you saw energy up, and you saw healthcare and renewable energy down. These are the kind of movements that you will see as we get closer to November. But I think the real rubber where the rubber really meets the road is in what the policies will be. So obviously, one thing that, if this is a Trump presidency, one highly talked about area has been tariffs. So what does that mean? Well, it means that we need to be very careful about owning, foreign companies that import a lot to the United States. Currently, we really don't have much exposure to that, but these are the types of things that we're going to have to work through as we get a finer view on the outcome of this election. Oh, and also just reiterate that something I said last month, which is that I think the biggest impact is going to be on what happens to the Trump tax cuts, that a lot of which expire next year. So there will have to be some sort of a tax bill that the next president will have to deal with next year, and that could have some pretty material impacts on not just personal tax rates, but there's some corporate tax related issues as well buried in there. And so we're going to have to really pay close attention to what happens. And even if Trump wins, but then doesn't win the Senate, I mean, that has obviously implications as to where these tax bills come out. So, and then back to the issue of, do we have any evidence that the Fed has kept rates too high for too long? And I think we're starting to see some. If we look at first quarter GDP, it would grew only 1.4%, which is down pretty dramatically from the prior 2 quarters of 3.4 and 4.9%. And it's even below what we saw throughout the first half of 2023 and the second half of 2022. So it does sort of seem like we are in a deceleration. Now, what I also threw in here was the Conference Board's estimates of 0.8% for Q2, which obviously we just finished, 0.6 for 3Q, and 1.2% for 4Q. Now this, I mean, you can even see that this is the soft landing that they're calling for. And I don't know, nobody knows whether this is a correct estimate or not, but the point simply is that I think there should be an expectation that we're going to see some deceleration in the economy. And that obviously can have an impact on certain stocks in particular. If we look at the Citi Economic Surprise Index, I brought this up maybe a few years ago, but this is an interesting index where basically when it's going down like it is now, it means that the macro data that is coming in is missing expectations. In other words, the street has been too optimistic and the actual data has been disappointing. And that's generally not good for, eventually for stocks, and generally not a good indicator of the direction of the economy. It's not, it's not 100% accurate by any means, but it is something to consider that, things are just not as rosy as people expected. Now, normally we'd say, oh gosh, where am I going to go hide, right? Because generally speaking, if we see a decline in the economy, stocks are going to get hit, right? Well, we, for the first time in a long, long time, have the ability to hide out in bonds. And that is a great place. That is a great option for a lot of portfolios, which is, again, goes back to why we are starting to really like this convexity trade, because you could actually get equity-like returns if the long end of the curve, those rates actually decline substantially. Now, I'm not suggesting that they will, and I'm not throwing up giant red flags saying, that a recession is imminent. In fact, we're still rather bullish, generally speaking, on the equity market, and think the economy is still showing some great sturdiness. But if things get worse, we actually have a place to go, and that is bonds and out the curve. So I think this is an important consideration. The other thing, but in the meantime, as I just mentioned, we're pretty much in a risk-on market with the VIX, which is a measure of volatility, down, sitting around 12, which is really incredibly low. Anything under 20 is considered to be a fairly calm market, and then therefore good for stocks. We're there. And now, can we get bouts of volatility? Absolutely. Could we get it with all this ruckus around the election? No doubt about it. But for now, this is a pretty bulled up environment. And then the last thing I'll just point out, and I've mentioned this in previous webinars, is that there is just so much money sitting on the sidelines waiting to buy dips in the market, whether it's bond dips in the bond market or in the stock market. Everybody, and we all know people, including ourselves, where we've pushed money into money markets because they're yielding 5.25% and they have no risk attached to them. Well, that if we look at the Fed's own projections where the Fed funds rate is going, we're going to have some serious decisions to make about where we put that money at some point. If you look at their projections, they believe that there will be, a cut this year, for next year, and for the year after that. That would put the Fed funds rate at 4.1% at the end of next year and 3.1% the end of the following year. So while they believe that there is time for you to go find better yields out in the market or maybe deploy into stocks, at some point investors will need to get out of the front end of the curve, and they will have to go somewhere else because the yields are going down. So something to keep in mind, particularly when you start to see dips. As long as basically we don't see the economy completely rolling over, these dips are going to get bought because there's just so much money sitting on the sidelines. So let me stop there, Tom, and let's take some questions.
Terrific, Jim. Thank you. Yeah, it's good stuff. While we're waiting for some questions to come in, I did have a couple, Jim. Why don't we start with these? Obviously our portfolios have benefited from the exposure to AI. And as you said, we're early in the game in terms of where you see this going longer term. Based on what we own now, at least in Global Vigilance, our moderate portfolio, where do you see not adding any more AI? When is owning more AI just too much for us?
Well, we do have risk parameters that will govern how much exposure that we can, max out on. I don't expect that we'll ever get to those limits because they are fairly generous. But it really comes down to, which stocks to own within that trend and being very disciplined on when you exit. So, one of the conversations I had yesterday was around NVIDIA. And again, we still own it. We still like it. It's great. However, the way that stock has gone to such incredible heights is a combination of three factors, really. One is basically you've had obviously tremendous revenue growth, right? They can't make enough chips for the demand that they have. And by the way, I have no idea when that's going to run out. I mean, but there will be a day, right? But for right now, there is insatiable demand for their chips. And we know that the Blackwell chip is coming out, but there's insatiable demand. There's insatiable demand, by the way, for Oracle's products. But Oracle hasn't run as much. What also happened at NVIDIA was you saw gross margins expand from sub 50% to close to 80%. So what does that do to earnings growth? It's like a turbocharger, right? Well, the turbocharger, I think, is pretty much gone from NVIDIA, right? I don't see gross margins getting much higher than 80%. That's pretty phenomenal. And they're probably not going to have the same vertical rise to revenue growth as they recently experienced. So in the backdrop of all this, you've seen their PE rise from 30 times to 45 times. So you've had sort of, multiple expansion, gross margin, increase dramatically, and then you've seen revenue growth. Well, at some point, we all know that eventually revenue growth will decelerate. Maybe, most likely they don't have any more gross margin to go, and then the multiple will have to come in. So there will be a day when, we need to get out of NVIDIA. And there are some other names in the market that have had, similar kind of meteoric rises on the backs of AI. You have to be more careful now about just plowing into an NVIDIA. But why not look at Oracle? It's super cheap. It's just now seeing the acceleration in revenue growth, right? So that's NVIDIA a year ago. So that's what we want to do. And then I'm sure Oracle will rip. And then the question will be like, okay, maybe which biotech company is going to rip because all of a sudden they're able to produce so much cheaper. They're seeing margin expansion. They're seeing revenue acceleration. That's the mindset. So it's like as AI evolves and is adopted throughout the economy, we want to keep hitting the places where that tidal wave is now starting to roll through. Does that make sense? Just to give a visual, because that's what it is. It's a giant tidal wave, and it's going to impact different sectors of the economy differently. But and maybe we don't see another extraordinary move like we saw in NVIDIA, but we're going to see big moves. And so I see us as sort of continuing to probably add AI exposure directly to your question, as we find these companies that are going to dramatically benefit from it. But as we do that, we may probably get rid of some of the ones that have already worked. And so, what we don't want to do is have a portfolio that is 100%, or 50% dedicated to AI and is that lopsided because, look, our number one goal is to preserve wealth, and our number two goal is to grow it. And we can't be in the business of losing people tons of money because we overstayed our welcome in a stock. And that's really first and foremost in our minds.
Yeah, makes sense. You referenced the election as a potential concern, something that may, in fact, potentially disrupt the markets. But you didn't say anything about any type of global geopolitical situation, either in the Middle East or Russia, Ukraine. Are those events no longer as much a concern as they were, half a year or a year ago?
Yeah, so I think what we've all come to learn about, for example, the Ukraine, the biggest impact of the Ukraine war was the impact of Russian sanctions and the impact on Ukrainian agricultural products. And I think the world is beginning to realize that these sanctions don't really work. The Russian gas is getting out there, and oil is getting out there. We're starting to see recoveries in agriculture or other areas of the world step up. Who knows what the weather is going to do when you start to talk about agriculture? We're shifting from El Nino to La Nina, and that means that different parts of the, different parts of the world are going to get wetter or drier, depending on where you are. So there's all sorts of other considerations beyond wars. But mostly what's happened is that it's turned out to be fairly irrelevant. And the Israel-Gaza thing is almost completely irrelevant from a macroeconomic standpoint. There are, some interesting considerations, though, when you start to look at elections around the world. So there's plenty of elections going on in Europe, Mexico, as we know. India just had a big one. And it's going to usher in different policies. And so as we sort of think about positioning around the world, we want to be in strong economies with stable governments that are pro-business, essentially. And so we are delighted to be in India. We love India. And we love being in Japan because we think they're turning the corner in their economy. And in our global vigilance portfolio, that's roughly 15% of it. So, we have a pretty decent size bet. But what we don't want to be is where we have tons of uncertainty. And, obviously, Europe has had to deal more directly with the impact of Russian sanctions. They've got all sorts of elections going on. We've really stayed clear of that sort of trouble.
Got it. Can you comment on a couple of big investment funds buying into multifamily?
Yeah, they just have a lot of money and they got to put it to work. I think they're early. I think we haven't seen nearly the correction we need to see in multifamily. But I mean, if you're Blackstone, you've got billions of dollars and you have to at some point start putting it to work. I think the bigger, whenever you have sort of a big correction in asset prices, oftentimes you don't see a lot of deals getting done, even if people want to get deals done, because the bid and the ask are just so far apart. But I think it's going to be, I think what they're sniffing out is that there's going to be a lot of potentially distressed sales. There's some multifamily, there's certainly office buildings that are going to get in trouble with their bank loans. And then sometimes the resolution is to sell it. So, I think these guys just have tons of money. They're investing for 10 years from now. If they get the right price, they'll put the money to work. I don't see really a way to play that trend in the public markets, but we're paying attention to it. Maybe we'll find something.
Great. As a follow-up question, this says, also, I'm reading that AI hype is well ahead of actual earnings impact. Are you cautious or more full steam ahead?
I think it depends on which company you're talking about. I mean, clearly there are some names that have really run and have massive valuations. And obviously when that happens, there's pretty high expectations that they will grow their earnings will grow into that valuation. I don't like being in those types of places, honestly. I would much rather be in a place where people haven't recognized the value that AI is going to deliver to that business in the future. So we're much more attuned to those types of things rather than stepping in and trying to chase momentum.
Great. That is all we have in the Q&A box, Jim. So I think it's probably a good time to wrap up. I just want to thank everybody for participating. I know it's a Wednesday before a very long and relaxing holiday. So thanks for joining us. Thanks again for your business. Thanks for your trust. And I hope you and your families have a great holiday weekend. And as a reminder, we'll follow up and send replay of this webinar. So thanks again, and have a wonderful 4th of July week.